Stop looking for the magic indicator. Seriously, I mean it. If you're sitting at your desk right now still trying to trade the markets using the exact same lagging tactics everyone was obsessed with back in 2020, you know what you're doing? You're essentially just donating your hard-earned money to institutional AI bots. So today, we're breaking down the absolute definitive blueprint for day trading in the modern era. We're going to take you from absolute zero to executing your very first trade with total confidence.
The stark reality here is that the market we're trading in today, it's fundamentally changed. It's way faster, it's significantly smarter, and yeah, for sure, it's far more volatile than it was even just a few years ago. But hey, don't let that intimidate you. Because the truth is, the tools sitting right in front of you today as a beginner are literally more powerful than the resources multi-million-dollar hedge fund managers had a decade ago. It's crazy. With the right blueprint, you can absolutely navigate the space and build real freedom. You just gotta stop playing the old game.
Okay, let's dive into this. Here's our roadmap for this explainer. We'll start by mapping out the 2026 market landscape, and then we'll look at the exact tech stack you need to actually compete. Third, we're going to break down a highly actionable strategy, the liquidity tab. After that, we'll cover the absolutely non-negotiable math of survival. And finally, we'll wrap up with the daily routine. Think of this as a literal masterclass. Ready? All right, Section 1, the 2026 market landscape.
Look, before you even think about clicking a buy or sell button, you really have to understand the environment you're walking into. And the absolute crucial concept here is fractional liquidity. Whether we're talking stocks, crypto indices, or those 24/7 global forex pairs, the game is no longer about trying to guess where the price is going to wander off to. Nope. Instead, your success relies entirely on predicting where the massive institutional orders are sitting. See, because of high-speed algorithmic trading, you're going to see what we call flash moves. These are moments where the price suddenly jumps like 2% in a matter of literally seconds, just because an AI somewhere triggered a massive buy order. So our job as retail day traders, it's definitely not to fight these bots. That is a completely losing battle. Instead, we want to act as market surfers. We just wait for the big wave to start, we hop on it, and we expertly hop off before the tide turns.
Moving right along, Section 2, the 2026 tech stack. Let's talk about the gear and the software you actually need to catch these waves. There is this massive myth out there that you need some $10,000 6-monitor rig that makes your spare bedroom look like NASA mission control just to be a real trader. You absolutely don't. All you need is a solid, reliable laptop and a really fast internet connection. Ideally, we're talking low-latency fiber or a strong satellite link. And in terms of your platform, you must have a zero-commission broker with instant execution. Back in the day, retail traders were always at a massive disadvantage because of slow, delayed data. But today, with today's low-latency retail platforms, you're operating at the exact same speed level as the seasoned pros. Mechanically speaking, you are on a totally even playing field.
Now, our absolute secret weapon in this tech stack is sentiment analysis. Most top-tier modern platforms actually feature this simple sidebar that compares retail sentiment directly against institutional sentiment, and it does this in real time. Think of this as your ultimate cheat sheet. If you look at this sentiment tool and it shows that, say, 90% of retail traders, the herd, are furiously selling a stock, well, the big institutional players are almost certainly looking to buy it all up. We use this tool to see exactly what the panicked herd is doing, and then we actively prepare to do the exact opposite.
To pinpoint exactly where we make our move, we gotta upgrade our charting. So forget about those outdated indicators like RSI or MACD for a second. Toss them out. Instead, we're using a tool called volume profiling to identify what we call value areas. Basically, a value area simply shows us the physical zones on a chart where the most money has historically changed hands. When the price of an asset hits these highly liquid areas, major market reactions happen. It's like clockwork. So we strictly wait for the price to enter these specific value areas before we even consider looking for a trade. Okay, getting to the good stuff. Section 3, Strategy, the liquidity tab.
Now for the absolute meat of this explainer. You've got the right perspective, you've got the tools, so here is exactly how we find a winning trade using a setup that's perfectly tailored for the 2026 market. Let me walk you through exactly how this happens chronologically. Okay, imagine a stock, let's just call it TechCorp, has been bouncing nicely off a support line of $150 all morning. Every single beginner trader looks at that chart and thinks, perfect, $150 is the floor. I'm going to buy right here.
And naturally, to protect themselves, they place their stop losses just beneath that line, maybe at say $149.50. Well, here is where the trap is sprung. Big institutions can actually see those stop losses sitting right there. They want to buy millions of shares of TechCorp, but to buy that many, they need thousands of people willing to sell. So what do? They artificially push the price down through that $150 support level. The price dips down to $149.40, and suddenly, bam, all those beginner stop losses are triggered. By definition, a triggered stop loss on a long position automatically becomes a sell order. The institutions then instantly absorb and buy up all of those newly generated sell orders at a massive discount.
In the aftermath of this trap, that's exactly where the magic happens. Because the institutions just bought a massive block of shares at a discount, the price violently snaps back up above that $150 mark. And that snapback right there, that is your golden signal. You don't try to guess the bottom. No, you wait patiently for that snapback to occur, which means you literally just watch the market tap into that trapped beginner liquidity. And then you enter your buy order to ride the massive institutional momentum upward. It's a clean, hyperlogical setup, and honestly, the best part is, it happens in the markets every single day.
All right, Section 4, the math of survival. I want to intentionally slow down our pacing right here, because what we're about to discuss is the exact reason why 90% of beginners completely blow up their accounts within their first 90 days. Listen to me on this. Amateurs treat the stock market like a casino. Professionals treat it like a rigid, boring business. Because 2026 volatility is so extraordinarily high, your risk management protocol has to be absolutely airtight. That means you follow the unbreakable 1% rule. You must never, under any circumstances, risk more than 1% of your total account equity on a single trade, period.
Let's quickly break down the math to see why this is so deeply important. If you have a starter account of $2,000, your 1% maximum risk means you're only permitted to lose $20 on a bad trade. Now, some people scoff at that and say, well, $20 is nothing, but they are completely missing the point. Losing a perfectly controlled $20 protects the remaining $1,980 in your account. It keeps you calm, it keeps you logical, and it keeps you safe from emotional revenge-fueled gambling. Every single time we risk that $20, we are aiming for a target profit of $40, which creates a strict 2-to-1 reward-to-risk ratio.
So here's the absolutely crucial takeaway. If you maintain that strict 2-to-1 ratio, you only need a 50% win rate to be wildly successful. Really think about that for a second. You can be wrong half the time. That's literally the exact same odds as flipping a coin blindfolded. But because your winners are twice as large as your strictly managed losers, you will still build massive wealth over time. See, in day trading, it's never about having a crystal ball and being right every single time. It is entirely about the math.
Section 5, the daily routine. You know, long-term success isn't just about what you do during the 3 seconds it takes to actually place a trade. It's heavily about the hours of discipline before a trade even happens. So here is the strict timeline you need to adopt. At 8:30 a.m., you sit down and check the global macro feed. Are there massive interest rate hikes being announced today? Are major AI sector earnings dropping? Look, if the news cycle is too hot and unpredictable, we simply choose not to trade. Capital preservation is priority number 1. Then, at 9 a.m., you chart your value areas and liquidity zones. From 9:30 a.m. to 11:30 a.m., your execution window is officially open. This is when market volume is at its absolute peak. But listen, if you don't see a perfect liquidity tap set up during this 2-hour window, you do not force a trade, period. And at 11:30 a.m. sharp, you close the laptop and walk away. Overtrading is a completely deadly disease in this industry, and strict boundaries are the only cure.
Before you officially finish your day, there's one last mandatory task: journaling. You've got to use an automated journaling tool to track your entries and your exits. But honestly, most importantly, you must meticulously log your emotions. Were you feeling anxious? Did greed make you hold on to a position way too long? Documenting this is absolutely crucial because your journal will show you the undeniable, objective truth about your performance. It shows you the very truth your ego and your brain will actively try to hide from you.
Finally, Section 6, paper trading homework.
We've covered a tremendous amount of ground in this explainer today, from identifying fractional liquidity all the way to executing the liquidity tap with strict risk management. But honestly, knowledge without execution is entirely useless. Day trading is a highly specialized skill. I mean, you wouldn't expect to successfully fly a commercial airplane just because you watched one single aviation explainer, right? You have to put in the simulator hours. So, your homework is to open a paper trading account today. This gives you full access to real live market data, but you're using fake simulated money. I want you to commit to practicing the liquidity tap setup on this paper account for the next 30 days without risking a single dime of your actual capital. You need to prove to yourself that you can follow the 1% risk rule and actually stick to that 11:30 a.m. cutoff time way before real money is ever on the line.
So as we wrap up, I really have to ask you honestly, are you ready to stop gambling and start actually surviving the 2026 market? The modern landscape is completely ruthless to the unprepared. But for those who master the tech stack, genuinely respect the math of survival, and wait patiently for that liquidity tap, the road to absolute financial freedom is wide open. You've got the blueprint now. It's entirely up to you to stay disciplined and stay on the path. Thank you so much for joining me on this explainer, and hey, happy trading.